Let's continue working on your mortgage vernacular. Fixed rate mortgage. This is a mortgage where the interest rate stays the same throughout the loan term. It's the most popular home loan program in the US because the payment is consistent and reliable, and it's also much easier to budget with your finances. Loan estimate. The loan estimate is a federal disclosure issued by the lender that outlines the costs associated with the mortgage. It will give you an estimate of loan-related costs, third-party fees, and other costs associated with borrowing the funds. The loan estimate must be issued within 3 days of completing an application. Home equity. Home equity is the difference between the value of the home and the amount that you owe on the mortgage. In essence, it's the percentage of the home that you actually own at that point in time. Home equity line of credit, also known as a HELOC. This is an open line of credit that's secured by the equity in your home. It allows you to borrow against an approved amount, pay it back, and continue to borrow. Works just like a credit card. Interest-only mortgage. This is a mortgage where you're only paying the interest in your payment, usually for the first few years of the loan. And because you're only paying interest, you're not paying down the balance and therefore not building much equity in your home. Now, eventually you will have to start paying both principal and interest, and when that occurs at a future date, the payment most likely will increase. Jumbo loans. These are mortgages that allow for a significantly higher balance than the conforming loan limits set by Fannie Mae and Freddie Mac. There's another video on who is Fannie Mae and Freddie Mac. Jumbo mortgages are designed to finance homes in higher priced real estate markets. Loan to value. That's where you divide the loan amount by the property's appraised value. This is a calculation that helps the lender to assess the risk in approving your mortgage. It can also impact the interest rate the lender offers you. Pre-approval. Don't be fooled into thinking that a pre-approval and a pre-qualification are one and the same. While they both represent your ability to get a mortgage, an underwritten pre-approval is where a lender actually reviews your credit profile and your financial situation and issues a preliminary approval based upon a specific dollar amount. This shows a potential seller that any offer that you make is legit. Principal, interest, taxes, insurance, also known as PITI. These are the major components of your mortgage payment. Principal is the portion of your mortgage payment that pays down your mortgage balance each month. Interest is the portion of your mortgage payment that pays the lender for borrowing the money. Taxes. This is the portion of your mortgage payment that's deposited into an escrow account, which pays your property taxes on an annual basis. Insurance. This also is the portion of the mortgage payment that's deposited into your escrow account that pays your homeowner's insurance on an annual basis. Points, also known as discount points. This is basically prepaid interest as a percentage of your loan amount. Paying points is a way to reduce your interest rate. The more points you pay, the lower the rate. Just remember, because you're paying the points at closing, you want to make sure that you're going to keep the mortgage long enough for it to make sense for you to pay points. And if so, how much in points should you pay? I hope you've enjoyed this segment of Wes's Wisdom.